If you do not bring the cash, you are the cash. Well, I know it sounds a bit harsh like that, but it is not wrong. You know, that famous trade you take and once you enter the market, it turns around and it's a loss. Or even the trade you're going to take, it's moving a bit in your favor and boom, it turns around, it's going to hit your stop loss. Yet it bounces back even more. You would have aced your task, analysis spot on, but no worries, it'll be fine. By the end of this video, you'll be able to spot liquidity on any asset, any chart. If you're up for it, let's go. Liquidity is what intelligent money loves. Well, yes, to operate in the markets, liquidity is extremely crucial for the intelligent money. I'll even tell you, it's liquidity that drives all this, because we don't do anything without liquidity. Let's start with the definition of liquidity. Understanding liquidity is crucial for trading and investments. You will get it. So here we start with the basics. Liquidity for me is synonymous with counterpart. If you don't have a quid pro quo, you don't have any cash flow. Actually, what does liquidity mean? That implies you need buyers for sellers and sellers for buyers, of course. Without that, nothing occurs. The price on your chart doesn't move. Anyways, we don't have any cash. So obviously, these liquidities combine at the level of certain prices on your charts, the asset that you are. It is going to be even more interesting on a stop order accumulation zone, because those stop orders are obviously going to highlight that some buyers or sellers are going to exit the market, which will give the counterpart the opportunity to enter the market. These are the areas we'll look where we'll identify order triggers. You have to know, like I was telling you, the smart money loves it because the bigger the order size, the more counterparties will be needed. So we're going back to the very foundation of liquidity. Remember this, we say that a market is liquid if you can enter a position and exit that position at any time. That means we have liquidity because we have easy counterparties in the market. Let me give you an example. I've got 100 phones to sell. If I don't go to a specific place where I'll find potential buyers for my 100 phones, I won't be able to sell them. I won't have any cash flow since no one will buy them from me, so I won't be able to complete my transaction. If I go to a physical point of sale, for example at a market where I'm going to offer the sale of my 100 phones, I'm likely to come across potential buyers. That is, people who can buy my phones. That's what we call liquidity.
Sure, ponder it now in trading terms. What does that imply?
That means that when we want to buy the market, we're going to need to have people or trading robots in front of us now, of course, who are going to be ready to sell the market. To buy, someone has to sell. To sell, someone has to buy. One person or several, it doesn't matter. Now let's consider liquidity in relation to the smart money concept, that is in terms of big capital. Large capital necessarily requires a larger counterpart to place extremely large orders because they possess a significant amount of capital and desire to inject it for the purpose of benefiting and speculating in the markets. They want to inject, of course, a big size of contracts, a big size of lots, whatever. You got the idea. And that's where it's going to come into play in your trading, because you and I are obviously not able to move the market. On the other hand, we'll be able to pinpoint these passages and potential areas where the smart money will want to go and find the counterpart before the triggering of the interesting movement. But where do we find the cash on the scratch cards? It's simple. First of all, we find it on all assets, on all time frames here. That's what's interesting. That's what's good. On the other hand, I'll tell you one thing here. Obviously, the rule remains the same. The lower the time units you're on, the more crucial and important liquidity levels will be. The smaller the time units you're on, the less these values will, of course, have a significant impact on the asset's movement and even on your success rate with these scenarios. So the question that arises is how to identify liquidity. We're going to see that on all the charts like I was telling you. We're going to look at Japanese candlestick charts, so Japanese candles. We'll be looking at the wick and the closing for different types, for example, of liquidity. We'll also have the basic of the basics. It's going to be peaks and valleys that can be individual or multiple. If they accumulate, we can get upward or downward trend lines. From there, we also have chart patterns like double tops and double bottoms that can help us identify these liquidity zones. And going further, it's obviously going to allow us, and for those who follow me every morning, live in the morning at 8 a.m. and 12 p.m., we have peaks and troughs that respect each other several times. It becomes a consolidation zone, a range. It obviously creates a lot of liquidity above and below this consolidation zone, this range, which is why I also identify false breakouts live every morning. Of course, we also have this liquidity phenomenon present in the trend, naturally. That's also where we're going to be interested in studying this part. In terms of liquidity in our trading, we also have the reversal of trends where we can find the presence of liquidity, which is also essential. How to draw liquidity? I'll give you a first example here on the downside. It's an example of eyesight liquidity. Why? Because we're going to come and pick up a summit that is this one. I extend the level of this summit. You see, we come and hit this summit right at the level of this wick here. We trap this summit, that is to say, we're going to look a little bit just above the stocks, for example, that were present just here to better trigger a movement that restarts the decline, which even allows to break the previous low. That's an example of liquidity taking a little higher to come down better, but on the other hand, we're going higher to trap and come down better. It's buy-sell liquidity because we're in a bear market here. This is how it will play out in a bullish market. Let's discuss sell-side liquidity instead of that. Here, let me show you. We just have a hollow. That hollow, it's going to be first test. We already have a fuse breaking slightly below, so we have a broken price level compared to this low point, so we already have a liquidity drain. We're going further just below to trap all the stops here, for example, buyers present in the market to get them out. To enter the market without counterparts, some sell with stop losses while others buy with these exits. The market rises, reaches the previous peak, and continues higher, despite initial selling pressure. As a result, those who exited with stop losses are now missing out on further gains in the market. It's a liquidity drain in a bullish market, so we'll talk about sell-side liquidity. How do you use liquidity in the SMC ICT approach? We'll be able to use it through different solutions. A directional bias, we can rely on this liquidity intake to have a directional bias, since we know that when we come to these intake zones, it's to act in the opposite direction, so it gives us a directional bias. We can use it as quality criteria too. The concept of SMC liquidity is really about understanding that it's a criterion to be respected, for example, before taking a position. We also have opportunities for buying or selling in relation to this liquidity injection, of course. So here there are three ways to use. For example, you can even combine them, of course, but to use this liquidity in SMC or even in your trading transaction. She knows theory, we'll jump into practical stuff with graphs. We're going to see something really important. For example, look at these peaks and troughs here getting lower and lower. That's Dow theory, obviously. Continuing, for example, here a lower low than the prior low. Then we make a high point, higher than the prior summit. So we're breaking the Dow theory, we're going lower but also going higher. We're going to study liquidity. We will examine it in terms of increasing the peaks and valleys. For instance, the formation of these peaks and troughs is extremely important in determining liquidity. We sketch all the peaks and valleys like that, it stands out more. We have highs, lows, keep rising, consolidates a bit, come back stronger, traps a bit, takes off again. So then here's another summit that keeps getting higher, etc. First level of liquidity. So here it's a liquidity grab for a trend reversal. Last liquidity catch here, we trap the last dip and the market turns around for a very nice trend. So already it can also be a way to identify the reversal of the trend. Then we have the formation of higher and higher lows, etc. Clearly, for instance, this first dip represents a liquidity threshold, the level of liquidity. We have stocks in the back, people buy and place their stocks in a textbook mode under the latest low when they bought, for example. So there are stops here, and when the market comes, it triggers these stop losses here. Afterwards, is it a big enough area or not, to generate this turnaround? That's another question, obviously. But here we have one level of utility, even a second level of value. So that means if I read both, I actually have a slash, and this slash signifies liquidity level. This liquidity is stops to be picked up. There are people who are going to be here, for example, who expect a bounce from this slope in a channel, etc. Well, they are also going to purchase position stops just below and get ejected. Because the market might want to go even lower, really look for liquidity below this low point, and then catch all those stop losses that have been triggered to find the counterpart, so buys, since here it stops in long positions. So when the stop loss is triggered, it's for buying positions behind. And there we react, we bounce back stronger, so it's like an oblique for us. Currently we have liquidity, obviously, in downturns. Then we'll have more of the idea, like the example I gave earlier in the theory of a double bottom, for example here. We're back here on higher and higher peaks, etc. But you see, here we have the formation of a dip. So these two dips here, actually a double dip, the classic chart pattern. And well, this dip zone will obviously generate some liquidity. Then we have this dip, which is a bit isolated. And if we want to add accumulation, we also have a slant. No accumulation, but there you can imagine under this double dip, there are people who bought, placed their stop just here, and also those who took the rebound with a retracement line and resurged, I want to say, to speculate on the rise. Very good. But the stop signs, like for sure, are placed there. Then when we're going to break through this liquidity threshold, even that liquidity threshold, we're going to come just below to grab all of that to go even further stronger, because there are stops here. When you close a buy position with a stop loss, it means you want to sell your position, but you need buyers behind it. And that's the concept we have here. Behind this movement, this kind of movement that really resonates, that really gives meaning to these manipulations, under the concept of smart money, of course, which are the big capital and which need this liquidity. Otherwise, they won't be able to enter the markets as they want. They need to go find liquidity where it is, at peaks, at lows. And here I give you the example in a market as well. Moving on to other examples. For instance, here we have the EURJPY, still on the hourly chart. Let's take a quick look at what's happening with these movements. Very interesting. You see there's a trough here, a trough there, and a peak there. There are obviously hollows, peaks, unable to break. We come back to find this level of liquidity right here. And that's where the market suddenly finds enough liquidity to go in the other direction. Bias of the trend, since we turned around a while ago, for example, on this limit here. However, here is the concept of the market trap. We can definitely label it as such, a liquidity crisis that will truly materialize in the anticipated initial situation. So here, for example, the buyers who are here, they most likely simply place stops right there, or even just here. Very few will put it there, for example, because it's going to be a risk reward for them that are too big, which will actually be too big stop losses, etc. So here we will pick up all the stops in this area. We are basically just going to grab the liquidity that happens to be right here. So there is more room for buyers to enter the market, especially with more interesting key levels. Here we have the first example of large movements. You see this upward push and then we breathe. So here is the first retracement. The same, we come back to a zone that acts as resistance, which can also act as support. We had a bounce, but it's not enough to reach the summit, for example, and even further. So here we have this clever dip. The market is going up a bit. It's not hesitating yet. And as a result, this dip is also simply trapped, you know. We're going to pick up a little bit below here. I'll rather put it in red for you. I'm a bit chatty. That level you see with this strand as well. It's well crafted. It's well crafted and tested. There are stop losses here. There's liquidity there. It's taken, and then we go up stronger. We'll reach this peak. We'll reach the other one. And therefore, if I'm not mistaken, we'll even go much further than that. We'll reach the peak and then we keep going. The USDJPY that I'm going to show you here, for example, we have a peak, we have a trough, we have a peak, and we have a trough. Same here, look, I'm showing you the previous hollow peaks. We'll discuss another concept. It's a liquidity grab, the last liquidity grab. We go up a bit higher, then change the trend. It goes down, we make this movement, we go down stronger, you'll see right after. We have liquidity just above peak, enabling us to reverse trend and then go down even stronger. So after that, we have this creation, like this peak here, this dip here, this peak and this dip. And look at what's happening. We have the break, so I'm going to fix that here. We have the break of this peak. Basically, we're creating a new peak here, but we'll find out later. If we take it step by step, we can see that we're breaking that peak. So it's a matter of taking advantage of it. You remember, above that summit there, what are we going to have? We're simply going to have stop losses for all the current short positions, because some people have also noticed that the market is turning around, so they want to sell the market. They have a stop loss, for example, above that, from that area. So from there, if we come to target that area, we'll trap that area, trap that peak to get more liquidity to go even stronger on the downside. And observe the movement that follows. A very nice example of a drop here. If you now know more about liquidity, how to identify it on your charts, how to use it, directional bias, quality criteria, or even opportunity, Don't hesitate to watch the two videos I'm placing here, SMC in relation to block orders and also with imbalances. These are elements that can complement each other. If we break one liquidity, observe these others, the outcome will be interesting.